Hi there, it's Monica from the Guru Intelligence Network here. Happy 5M Monday. So today we are going to continue our discussion on Moat. And last week we were discussing what a moat was and how to determine whether your company has one and maybe it's got multiple moats. And this week we're going to continue by talking about how strong the moat is. So just going to go in here and share my screen. So how strong is your moat? So we've determined we've got our castle, which is our company, and we've got a moat around it trying to protect it from intruders. And now the castle's being attacked. So will our company survive this attack is the question. And just going back to Warren Buffett here, so his thoughts on moat, he says that the key to investing is not assessing how much an industry is going to affect society or how much it will grow, but rather determining the competitive advantage of any company and above all the durability of that advantage. So last week we identified the competitive advantage, and now this week we're going to determine how durable that advantage is. And so how do we do that? Well, it's really quite simple. There's 4 growth rates we like to calculate, and these numbers can actually be pulled from the annual reports, and we just need to calculate the growth rate for them. So the 4 growth rates are shareholders' equity per share, earnings per share, operating cash flow per share, and sales. So all of these numbers are found in the financial statements in the annual reports. You'll need 10 years worth of those because what we're looking at is mature companies, and the more data we have, the better. So if you can get 10 years worth of annual reports on the particular company you want to invest in, then that's fantastic. And these numbers are actually calculated for you, meaning the shareholders' equity per share is calculated for you, earnings per share is calculated, operating cash flow, sometimes it's referred to as just cash flow per share as well, and the sales numbers are all in there. It won't calculate the growth rates for you, so that's something you have to get your calculators out for. But it's a really simple calculation. You just want to take your most recent number for each of those 4 and compare it to the 10 years, 7-year, 5-year, and 3 years. That way you can see how well the company is growing. And typically we want to see numbers that are 10% or higher, and we want to see them growing over time. You may have a really well-established company that has relatively stable growth rates, and that's not a bad thing either. But we do get a little concerned when we start seeing shrinking growth rates. That can indicate that your moat has been breached and your castle is under attack. So that is what you'll need to look out for. And if you do see that, you'll want to determine what is causing that attack and whether the company can actually shore up the bridge and stop invaders from intruding. And so Warren Buffett has another quote I really love. He says, "Someone's sitting in the shade today because someone planted a tree a long time ago." So if we look at a company as the tree and how much shade it's giving off today, it's because it grew over time. So if the tree has grown a lot every year, you're going to have more shade, you're going to have a bigger, healthier tree. And that's a really good analogy for the companies that we're looking at. So I hope you really enjoyed this section on moat. This concludes our section on moat. Next week, we'll be looking at the 4th M, which is management. And that is a really important one to look at as well. And I hope you have a really good week. I hope you're enjoying these videos. If you are, please like, share, and subscribe to these videos. Go to guruintelligencenetwork.com for more information. And I hope you have a really good week. And we'll see you again next Monday.